Hello, everybody. Brian here from quantlabs.net on Sunday night, January 7th, 2018. I just wanted to highlight something here is that my system is not putting as much attention onto cryptocurrencies anymore. So I'm going to show you two different stories that it's sensing that have probably more potential. But I've been the last week to 2 weeks with the rise and sudden falls of Ripple and Bitcoin. I guess my system's not tracking it as much. So I'm going to show you two stories that we should pay attention to. The first one here is from Bloomberg about the chatter about potentially making some money on privatization proceeds that are coming from projects that Greece or the Greek government's trying to get off the ground for later in the year, and it's going from 2 billion to 3 billion. There's a lot of conditions on that. 10 different conditions you may want to check out in this article at Bloomberg. Again, these articles are behind my paywall of my Quant Elite membership. Anyways, going on to the next article from MarketWatch. This one's not anything revolutionary that's said about the hidden reason why stock market volatility is so low while the markets are hitting all kinds of records. The interesting thing is that I'll show you another chart, but when things start to get too low, complacency sets in the market, especially when the markets start to hit records. And not sure if it's this article or last article, but oh yeah, here we go. 47 of the record lows of the VIX, so the CBOE volatility index, hit last year, 2017. And basically, what happens is once you hit those kind of records, you get a lot of complacency. So as a result, there's a lot more risk taken, and it's those risks that can backfire. And obviously, that's what started the mortgage packaging of bad mortgages, package them up with grade A investment ratings, and that's what started the 2008 financial crisis. So it's these sort of scenarios that can be dangerous. And there's also a mention in this article about how the correlations of standard correlations have broken down to pretty well zero point 0.1. And there's also some debt ratios as well that you need to be aware of. So again, that's all in these articles. Another article here from realmoneyatthestreet.com. It's been a sustained move under 10, and this guy's saying that he expects it to change, and he gives his reasons here. A lot of volatility in September, October that year. Some have said that there's a precondition on basically the market is pretty well similar pre-crisis of 2008. And what will blow, I don't know. I think if anything, it'll be the bond market that will blow up, as well as the excessive debt that nobody's talking about right now on the political scene in a lot of the Western governments, because obviously it's just something that they don't want to talk about. But let's say for the U.S., one of the biggest programs now that are paid out of the U.S. budget that nobody knows about is the interest to service the national debt. So here, there's this daily sentiment index, 88 for the S&P 500, 77, so that's coming down, it looks like, but now it's the DSI is 93, and he mentions oil is now into the 60-65 area. This overbought, oversold oscillator, which is similar to the RSI, and highlights the interest in the chart. It's hard to be assembly bearish on oil when it acts so well, but it could use a few days of cooling off as well. Probably has to do with the dollar index getting oversold and need of a rally back to resistance. So again, there's this article at the real money, or sorry, the street.com. Hopefully that will give you an idea of what's going on in the markets over the last little bit, but not a lot of big news on the cryptocurrencies yet. Not like the sunrise of Bitcoin, but I'll probably do this again in a couple days and see where everything's at. All right, I'll talk to you later. Bye.